Good evening, everyone. We'll be discussing PGBP profits and gains from business and profession today and depreciation. When you solve a PGBP problem, you get a profit and loss account, and beneath that, you get all the adjustments. So, this chart is based on the basis of question. So, on the in the question, on the credit side, you will see incomes. On the debit side, you'll see expenses. This In this chart, this is income. This line is income, this one, and this line is expense. So on the credit side of the P&L account, you may have 2 to 3 line items. Say suppose first item would be sales, gross turnover. Okay. Second would be suppose sales tax refund. So sales tax refund it will be taxable in the current year if it had been allowed in any previous years. Okay, so section it is as per section 41. 41 provides that any expense allowed earlier, either paid or unpaid, if it is received in the current year or the creditor has waived, then the amount that had been claimed earlier will be taxable now. Okay, so I'll give you one more example. For example, refund of income tax. Will it be taxable? No, because because income tax was never allowed as a deduction. So why will it be included as income? Again, another example would be excess gratuity provision written back. Gratuity provision was never allowed in the first place. For example, it was not allowed in the first place. So if it is written back, it will not be taxable. Okay. So you have to check. This is C. You have to check whether 41 income is already included in the books of account in the net profit. If it is already included, we don't have to do anything. If it is not, we have to add. So if sales tax refund is already credited, we don't have to do anything. Okay. Our starting point for computation of PGP is net profit as per P&L account. Okay. We'll add 41 income if not credited. We'll deduct any other heads of income, house property, dividend, other sources, capital gains. As soon as we deduct the income, we will make a separate computation for that head of income. So that we don't have to leave any of the line item out. We have to close the P&L account and the adjustments, one adjustment and one line at a time. I would recommend you not to look at that adjustment or that line item again. Complete everything with in relation to that adjustment. So for example, if you reduce other heads income, you go to the adjustment side and then look for capital gains what all information is given. For example, indexed CII, cost inflation index is given, cost of acquisition is given. So you index the cost, you calculate the sales value gain, and then move forward. Okay, this is easier for you to complete the problem inside 30 minutes. You need to complete this problem in 30 minutes so that you can attempt the whole paper. This problem is the biggest in direct taxes. Then if we see exempt income, for example, agricultural income, we have to reduce. Again, as soon as we see the agricultural income, we have to see the debit side if there are any expense related to agricultural income. So this is what we call a circle or a chalk where income and expense both are related. As soon as we see exempt income, as soon as we see exempt income, we'll deduct. We'll check any expense debited to P&L account related to exempt income. We'll add. This is as per section 14A. 14A also provides that if AO is unsatisfied about the computation, then can compute the amount to be disallowed as per rule 8D. It says that you can include direct expense plus 1% of average of monthly average of value of investment. So we'll calculate the value of investments. We'll calculate monthly average, opening and closing monthly averages of every month, and then we'll calculate the average and we'll multiply by 1%. We'll get the amount to be disallowed. Okay. Now there are three conditions to be satisfied to claim an expense. First, it should not relate to exempt income, like we discussed now. The second condition is it should be covered under section 30 to 37. Third condition is it should not be disallowed. Okay. Second condition is it should be covered under section, this is 30 to 36, this is 37, and it should not be permanently permanently or temporarily disallowed. You seeing the shape? This is P, this is T. These are permanent disallowances, these are temporary disallowances. Now, section 30 to 36. We'll be discussing some of the sections tomorrow, like 35 AD, uh, this is 33 AB, scientific research, and this is telecom license. We'll be discussing tomorrow, but some of the sections we'll be discussing right now, like insurance. Insurance for employee is covered under section 30 to 36. We'll discuss 30 to 36. And section 37 is a general section under which any other expense which is not mentioned in section 30 to 36 can be claimed. Okay. So 30 to 36, insurance expense. There's some criteria here. Insurance for employee cannot be paid in cash at all. Insurance of stock can be paid in cash. Bonus, provident fund contribution, interest, bad debts. About these bad debts, there are two conditions to claim bad debts. The first condition is it should have been included in income in any previous year. It should have been included in the income in any previous year, as in if I'm writing it off in 1819, financial year 1819, then it should have been included in any income previously in the preceding years. And the second condition is it should be written off in the books of account. Provision for bad debts are not allowed. Provision for bad debts are allowed only for specific undertakings like banking companies, NBFCs. For only for them, this special provision was applicable for deduction of provision for bad debts. Normal cases, we have to write it off in the books of account. So for bad debts, there are two conditions. It should have been included in the income. It should have been written off. For an expense to be claimed, there are three conditions. First is it should not be related to exempt income. Second, it should be covered under section 30 to 37. Third, it should not be permanently or temporarily disallowed. Okay. Now we'll be discussing about section 37, which we have to do it nicely because we have to write a note in exam, because most of the questions cover section 37. Section 37, we have, if it covers section 37, we have to write why is it allowed or why is it not allowed for a particular line item. Okay, so to memorize section 37, we have a memory technique. Psi general store. Psi stands for three letters, general stands for seven letters. Okay, so section 37, we have to write the section in exam as well, so I'm making it easy for you. It's Psi general store. It is a general store. Why? Because it is a general section. These are specific to all in expense. This is a general section. Okay, Psi general store. Now, when you enter the store, there's a photo of Priyanka Chopra and it is crossed. Okay. And when you enter the shop, the shopkeeper says that anything I do it for business and only for business. So you ask him to show some chairs, and he says, "Sir, please have a look. Anything I do for business and only for business." So when he was entering the shop, there was a photo of Priyanka Chopra and it was crossed. So PC is not allowed. PC not allowed. Personal expenditure not allowed. Capital expenditure not allowed. Then when he entered the shop, then he asked the shopkeeper. He mentioned that what we do it for business and exclusively for the purpose of business. So the third condition is the expense should be incurred wholly and exclusively for the purpose of business. Okay, so there are three conditions: personal expenditure not allowed, capital expenditure not allowed, Priyanka Chopra photo cancelled. We enter the shop, the shopkeeper says anything and everything we do it for business. So the third condition is the expense should be wholly and exclusively incurred for the purpose of business. And there are two more things: CSR expenses and illegal expenses are not allowed. Then for permanent disallowances, 48.3 covers payments made in cash up to 10,000. If it is made, the amount is 10,001 rupee, then disallowed. 35,001 rupee, then it is disallowed. 35,001 rupee in case of flying, hiring, or leasing of goods carriages. Okay. Specified person, if payment is made to a specified person and payment is more than FMV, the excess will be disallowed by you. There are certain there are more deductions, disallowances rather, like 40B. We'll be discussing in assessment of various entities. 48.3A. So 48.3 says that if you have made payment in cash, it will be disallowed. Actually, it doesn't say cash. It says any mode other than account pay check, account pay draft, or ECS. Okay. And rule 6DD also provides that if payment is made through debit card, credit card, or other banking channels through which the recipient can be traced, then the disallowance will not be made. Okay. But if I have not made the payment in the current year, so for an expense to be claimed, I had satisfied the first condition that expense was not related to exempt income. I had satisfied the second condition, it was covered under section 30 to 37, and it was not disallowed because payment was not made at all. 40A3 did not arise. Now I had incurred the expenditure in FY 16-17. Now I'm making the payment in FY 17-18. 17-18, in the year 17-18, the expense will not be debited to P&L account. So can it be said that I will be disallowing the expense? Not a question, because it is not debited to P&L account at all. So what do? We include that amount in income. This is section 40A 3A. Temporary disallowances. There are certain payments that has to be made in within the due date of filing the tax return. So here, this is the due date. Certain payments like interest, taxes, duty, EPF, bonus, railway assets. These are to be paid within the due date. If not, it will be disallowed. It will be disallowed, and it will be allowed in the year of payment when payment is made. Okay. Similarly, TDS, if not deducted, it will be disallowed, and it will be allowed in the year of payment of TDS. Just one quick thing here. You would like to notice here that there are certain expenses that are covered under section 30 to 36, which are also covered in section 43B. So if we have to say that any expense like interest, bonus, CPF contribution Can it be allowed? Yes, it can be allowed under section 30 to 36, but you have to pay the amount within the time limit. Not only that, for specifically for interest, you have to also comply section 40A TDS. Not only that, you also need to comply 40A 3. It says payment cannot be made in cash. So only one disallowance is enough to only one disallowance section applicability is enough to disallow the expense. Now this was a whole method how we can compute the profits and gains. For depreciation we have a memory technique IOU 180. IOU 180, it says I should own the asset, it should be used for the purpose of business or profession. So IO means I am owning the asset, U means using it for the purpose of business. So the first condition is IO, second condition is U. Okay. Now for the ownership, is legal ownership is important or beneficial ownership? As per Income Tax Act and as per various judicial pronouncements, it has been decided that beneficial ownership is important and not legal ownership. Okay. If I've purchased during the year and I've used during the year for less than 180 days, then half depreciation will be allowed. Used less than 180 days, half depreciation will be allowed. For additional depreciation, since the government says that we do not want to postpone development of India, the government has allowed balance 50% additional depreciation in the next year. This is additional depreciation, this is depreciation. Okay. Now what if I purchase the asset during the current year and make the usage in the next year, and in the next year I make it used for a period of less than 180 days. Will half depreciation will be allowed or 100% depreciation? It is 100% depreciation. Please do not make a mistake of mentioning that half depreciation will be allowed, because half depreciation is allowed only in case when you purchase the asset in the current year, use the asset in the current year and use it for less than 180 days. So if you purchase an asset during the current year, during the previous year, and you use it during the current year, the provision is not applicable. You'll get 100% depreciation. Okay. Once we satisfy IOU 180, we can for Salim generators and distributors for uh, who generate and distribute electricity can take an option of SLM. Others have to take WDV. For SLM, if the for SLM the depreciation is calculated on the actual cost every time, and for WDV the written down value is calculated every year and accordingly depreciation is calculated. WDV has a concept of block of asset. SLM does not have a concept of block of asset. So every time a sale is made, either a short term capital gain or loss or terminal depreciation is calculated. So in the case of first year, if it is sold, short term and capital gain or short term capital loss will be calculated straight away because no depreciation has been calculated. If it is sold during the subsequent year, if sold, if the WDV is this amount and you have sold it for even more than cost, your cost is this, your sales value is this, your WDV is this. Now you sold for more than cost and WDV, so the difference between sales value and cost will be capital gains. The difference between between cost and WDV will be balancing charge. Balancing charge will be taxable in the under the heads of PGBP. Why? Can someone understand the logic? The logic is, since you have been claiming depreciation, the difference between WDV and cost is depreciation. So since you have been claiming depreciation under the head, PGBP will be taxing you that specific amount under the head PGBP. Same here as well. If you are sold beneath cost, sales minus WDV will be your balancing charge. If you are sold for less than WDV, then what happens? It will be terminal depreciation. So if the WDV is 20 lakhs and you have sold it for 10, so 10 will be terminal depreciation. It will be deducted from income. So this is the whole computation of PGBP. Um, there's a shortcut method to compute PGBP. I'll tell you. We go through sales. In the longer method. We go through sales. We go through expenses. We go through income, permanent, temporary disallowances, and then we reach PGBP. What other option do we have? We will go directly from sales to PGBP. This is called presumptive taxation. Presumptive taxation says if your income in case of business is less than 2 crores, less than or equal to 2 crores, 8% or 6% of income will be your, since 8% or 6% of your sales or turnover will be your income. 6% if for the amount that you have received in account paycheck mode, account pay draft or ECS. Now for profession, it is 50 lakhs limit, and 50% will be your income, 50% of turnover. These are the provisions for audit. These are provisions for maintaining books of account. Limits for individual HUF, others, professions limit is all of last 3 years gross receipt should be 1.5 lakhs. Okay, so this was from of this is it for today, and we'll be discussing depreciation tomorrow. We'll just have a quick recap of 1 minute. So we start off with by saying that we start with sales, we reach to PGBP. Okay, to reach PGBP we have to first check the credit side. Credit side may we check whether section 41 income is credited. If not credited, we have to deduct other heads of income. We have to deduct exempt income. Similarly, we have to see expense related to exempt income. We have to add them back. For claiming for claiming a deduction or expense, three conditions are to be satisfied. It should be covered under section 32, 37. It should not relate to exempt income, and it should be not permanently and temporarily disallowed. Okay, if these three conditions are satisfied, we'll claim the benefit of expense. We'll calculate PGBP, or a shorter form or shortcut, scales directly to PGBP, presumptive taxation. That's it for today. We'll discuss depreciation tomorrow.